So thank you so much for joining me. Today I am in Toronto, Canada, and I'm delighted to talk to you about debt modeling, but more specifically about stress testing of that scenario. So the session today is going to be about what is the impact of changes in, for example, interest rates or market rent on your ability to pay back debt. Okay, so I hope you came for this topic and I hope you stay here for this topic as well. So I'm going to start here sharing my screen, okay, with you, and I'm going to do the normal thing, which is start sharing a little bit the whole thing. Okay. So, welcome everyone. Today's session is about stress testing real estate debt investments and its scenario analysis in your financial models. Okay. What we're going to talk about. So, why stress testing matters, real world risk mitigation. So, I'm just going to read here for you, but that's investments are inherently exposed to market fluctuations and economic volatility. Rising interest rates, tenant defaults, and expanding exit yields can dramatically impact your expected returns. Comprehensive stress testing prepares your portfolio or investment, if you're investing in one property, for downside scenarios that might otherwise catch you off guard. This proactive approach helps ensure ongoing covenant compliance and delivers truly risk-adjusted returns. So the reason why we stress test is because we want to find out, okay, if something hits the fan, what is going to be your position, okay? And you know what this something is. This something is pretty much related to interest rates increase because there are two ways that interest rates impact our returns in the real estate markets. If you have come to my course, you might know by now, which is it will increase your debt service, so your payment of interest if you are in a floating debt facility, or even if you are in a fixed one, it might be that you have, for example, you will have exposure to your exit yield, and then the exit yield is pretty correlated. So it's very much dependent on the direction of interest rates. So if interest rates go up, the exit yield will go up. Exit yield going up, your values will go down, and then your loan to value will go up. And then with the loan to value going up, it might be that you can't pay it if it is more than 100%. Okay, so that's the idea of stress testing, is checking if variables, your inputs, your assumptions change over time. Um, what happens to your covenants, your ability to repay, or if you are the lender, your ability to recover the money that you have given out, that you have lent. Okay, so this is why stress testing is very important. And it's interesting that we're here because I had this conversation with it's a commercial bank, but one of the largest in the UK. And then the head of real estate there, they said, well, like sometimes we might not need to do the whole stress testing, but the problem is if you don't do it, is and the market turns against us, we have nothing to call back to. So that's why, a lot of people have this kind of valuation as gut feeling. But if you really want to stress test, if you want to test scenarios, then it's very important that when you do your valuations, either from an equity perspective or debt perspective, or if an equity perspective and a leverage perspective, that you do build a cash flow model. Just don't do like the rent divided by the yield. So that was the kind of conversation that you can have, like very high level valuations, but then that it's really hard for you to pick up those nuances in changes of interest rates, what is going to happen to your cash flow, your ability to repay. And a lot of times people will say, well, I'm not going to do a full-blown cash flow rent divided by the yield is good enough for my valuation. But that's not very um, well perceived when you're doing risk analysis. Okay. So that's the idea of doing stress testing. So what I would like to say is that it is important because you need to see what's going to be the impact of variables turning against you. And one of the most important variables is the interest rates. If interest rates go up, because your debt service will be higher, your yields are going to be higher, values are going to be lower. And then the other thing about the stress testing is that it needs to be done on the cash flow. Okay, so don't try to do a normal term and reversion or hardcore method valuation with the debt amount and think that it's going to happen like that. Okay, so make sure that when you do the stress testing, you have a cash flow. Um, what is scenario analysis? So scenario analysis is the systematic risk assessment. So we can either do a sensitivity analysis, or we always do a sensitivity analysis, but it's a way for us to say, okay, what happens if interest rates go up? What happens if the market rent goes up or goes down? What happens if my vacancy is longer than expected? What happens if my construction timeline is longer than expected, or my construction cost is higher than expected? So it's really trying to forecast or foresee the if normally when we're doing this from a debt perspective is just seeing what is the downturn, because with the downturn, because what we're trying to see, like, we able to pay back the debt? And then the lenders is always trying to ask us, like, are you able to pay us back? Okay, so this is like the downside protection is very important when we're doing this scenario analysis. And it is a way for us to check against adverse event simulation. So we're going to see what are the shocks. And then one anecdotal that you are familiar, maybe in 5 years' time, people won't be that familiar anymore. But then, in 2020, when interest rates really like went from almost zero to 4 or 5%, who could have forecast that, right? But then if you had stress tests, and then if you had done the proper cash flow, and then you looked at it, it would have been one of the scenarios. Unlikely, but it would have been one of the scenarios. And hopefully, it would have been more prepared for the scenario as it happened than the people that just did kind of like a more back of the fact valuation. Okay. So this is one thing that I would like to stress with you, that when we're doing the underwriting, this part of the underwriting is very important. Like, what happens if things go against you? Okay. Um, Performance metrics evaluation. So that's also part of the scenario. Like, okay, what happens if the interest rates go up 1%, or the construction costs go up by 10%, and so on and so forth? What is going to happen to your ability, your performance metrics, your ability to pay back the debt? And then normally what we look at it is the covenants, and then it's the covenants tend to be the DSCR, which is the debt service covered ratio, the ICR, which is the interest covered ratio, LTV, loan to value, and even the IRR of the project, right? Or the equity multiple, because you have to pay back, you have promised your investors some return, either from a debt perspective or from an equity perspective. You have made promises to your shareholders that you would deliver some return. So you need to test those in terms of your performance. What is going to be the impact if those things, if those scenarios change to what you are expecting from the base case to a downside case. Enhanced risk management. So of course, this is the main reason why we do this, is to do the risk analysis, because we need to make sure that what are the risks of you not being able to pay back your debts? Like, what are the risks of you not being able to return the capital to the shareholders, or whatever is like the required returns, right? So then you need to have it's your ability to give this enhanced risk management or a risk analysis. Okay. Common scenarios to model interest rate hikes, of course, from a debt perspective, and in real estate, this is one area that will affect us the most because of what we mentioned before, the debt service and the yields, and then tenant breaks increase the vacancy as well. So we can model those. What happens if the tenant breaks or the tenant goes bankrupt, and then we have like a vacancy? What happens to that? Rent reductions leaves up delays. So what happens if you have the ERV, for example, as we're gonna model here? What happens if you're expecting to be 100 pounds per square foot or $100 per square foot or 1,000 euros per square meters? What happens if those things change? And then what happens if you have like delays in your lease up? You're expecting, your hotel to be in full operation with 99% occupancy by year three, but then you're not there yet, and then you think it's going to take like another 4 or 5 years. And then what's going to happen? Are you able to service your debt? Are you going to need to have to ask for an extension of the period that you don't pay interest, for example? So you need to think about all those what if scenarios beforehand. Okay, construction cost overruns. So we need to simulate as well what happens if there are increases in the cost because of, like you made a mistake in costing. That happens. Or you made a mistake in like you start building and then you find ancient architecture, and then you have to stop and do things. Like all this will cost you time and money, so you need to think about those variables as well. And then lower exit values, because you're going to have higher interest rates, so then you have to think about the lower exit values as well. Are you able to pay back the debt? So that's also, like, from a borrower's perspective, that's the question we need to ask ourselves. And if we are the lender, are we able to recover, the capital, the principal at the end of the loan, at the maturity period? And then extended holding periods as well. So we need to extend, especially like holding periods where uh, we don't have income, for example. Like, so if we have like extended holding period of construction, so it's like mainly like construction delay, because you're not going to be receiving any income, but you still have interest being accumulated on your debt. So you need to model those scenarios as well. So these are here like just some examples of variables that you can stress test. You can change in your analysis, so then you can see what's the impact of those changes into your ability to repay or the profitability of your investment. Okay. And then we're going to do a live walkthrough overview. So define base case. So the most important thing is to define your base case. And that's what we teach in our modeling courses. Like, we define the base case, what is going to be, the scenario that we find the most important ones, the most likely ones. And then we have to test those for all the scenarios. So we're gonna do, like, define the base case, and then we're gonna apply a scenario rate increase, NOI reduction, or market rent reduction. We're gonna generate a sensitivity table, and then we're gonna interpret outcomes. Okay. So my base case scenario is one that you're gonna have 18.4 million as loan amount. So this is the senior debt facility, interest rate of 6%, and 1.9 as net operating income, and 1.1 as annual debt service. Okay, it's an interest only payment, so it's a debt service and interest coverage ratio. And then that will have 1.72 the SCR, so it's well above the 1.5 covenant that we have in the scenario. Okay, so this is our base case, and I've created a model here for us to check this base case. So this is going to be our base case. So this is the asset, is just an example of an asset that will have just two tenants and then it's a multi-let because it's only two tenants, but it's still a multi-let, and then it's a commercial property, so it can be said it's like an office. Okay, so that's so we're gonna buy this for 30.7 million, and then we're gonna borrow here 18.3 million, 18.4 million. That's what I said here, the loan amounts, which means a 60% loan to value, day one loan to value. Okay. Um, and then what else we have here? 6% interest rate. So that's our base case. And then 1.9 is your net operating income for the first year. So here our cash flows are quarterly. So therefore, if I sum the four first quarters, then we're gonna have here 1.9 million. So it's around like 475,000 per quarter. So 1.9 million per year. And then our debt service is going to be the four interest here. So it's going to be around 1.1 million. Okay, so the 4 quarters here, if I highlight here, then I see here that the sum is 1.1 million, which is what we have here, 1.1. And then the debt service coverage ratio, which is what is the coverage? So it's going to be like the yearly NOI, so the 1.9 million divided by the 1.1 million. Okay, so that gives us the debt service coverage ratio. So it's the sum of it's the annual rent, annual net rent or NOI divided by the interest. And this is because I don't have it's an interest only scenario. Okay. Right. So this is my scenario, and then what we want to do here is gonna say, okay, I need to stress test it. Okay, so this is the part that is gonna be my demonstration for you, which is the sensitivity analysis. One thing about the sensitivity analysis is that you really need to think about the scenarios. Like it does take a lot of time for you to run the sensitivity tables. Your spreadsheet tends to get bigger and bigger the more sensitivity tables, the more data tables you have. So when you're going to test the model, create the scenarios, my recommendation for you is that you really think about the scenarios that you want to stress. Don't just go like often and like I want to test all the variables possible and create all the pairing as possibles and so on and so forth. Be more efficient with the variables that you want to test. But in this case here, we want to test two scenarios. One scenario one is the interest rate increase, and then the scenario two is the ERV reduction. Okay, so I'm going to create here what we call a data table. Okay, so I'm going to create here with you a data table. And my data table here is one with a two entry. So we're going to have NOI and the interest rate. NOI is going to be in column, and the interest rate is going to be in rows. And then here, what we're going to say, okay, we're going to start here with my base case. So what happens if my NOI actually is not the NOI that I want to test, is my ERV here. Why is it ERV? Because this rent here is one, my scenario here is one that is going to be fixed, and it only changes in 2026 and 2030, for example. So this scenario here is one that is fixed for this period of time, and it's only going to change when you have reviews or you're going to have a break on expiry. Okay, so even if you say, okay, your NOI should not really change between 21 and 26 and 25 and 2030 for those respective terms. Okay, so what makes more sense is to stress then, and that's also another thing I would like to mention, that you need to understand the economics of your of your model, because otherwise you might be stressing things like NOI. If you're gonna stress like 10% every year, does it really change 10% every year? You can't, like, because you are in a fixed contract, unless it's residential that you have like shorter review cycles because it's an annual review or indexation, then that will make sense. But otherwise, if you're a commercial that is fixed for 3, 5 years, it shouldn't change. Okay, so it's going to be here 0, 10% is what is my assumption, 30%, 40%, and say 50%. And then here, my interest rate. So my base case is 6%. And then you're gonna say, what happens if it is 7? And then I can highlight both and like 7, 8, and 10. Okay, so that's what we call sensitivity table. And then here, what we want to test, for example, is the DSCR. So the DSCR, what we want to test is the minimum of your DSCR. So you're going to test here the mean of the DSCRs that we have here, and it's 172. Why we want to test the mean? Because if it is lower, like the lowest number being lower than the covenant, in our case being 1.5, this is the time that it breaches your covenant. Then it's you are in breach. Then there's a problem because you are not compliant. Okay, so that's how you set up your sensitivity table. One thing about this ERV is that you need to connect those 0, 10, 30, and 40, right, with your inputs table. So therefore, what I have here is the sensitivity dummy variable. So it's 0 here. And then I'm put it there. And then what I need to do is I say, okay, how do I change my ERV? Okay, so my ERV here is on the forecast of my rent. So my rent forecast here. So in this case, the 10% will only have an impact when you have a rent review. So when do we have a rent review here? In 2030. And when else do we have a rent review? In 26 and 2030. So in 26, this might have an impact, okay, in 30th of September 26, and on the 31st of March 2030. So how are we going to input that? So we need to then make sure that in this formula here of the forecast, okay, this is the formula of forecasting, that you include those dummy variables. So it's going to be your, so F36 is your ERV. So you're going to make the ERV dependent on what happens if it is 0, what happens minus 10. Because if it's minus 10, then that means here that this F36, which is your ERV here, your net effective ERV is not going to be 930,000. It's going to be 930,000 times 0.9, because it's just going to be 90% of that ERV. Okay, so this is how you connect this table here with the actual calculation. So once you've done that, then all you need to do is highlight everything. So we're going to highlight here, and then we're going to go to data tables. Okay, so maybe this is something you're familiar with. So you're going to go data, what if analysis, data table, and then you have the row input cell is the interest rate. So we're going to go to the interest rate in cell D8, and then call your input cell is my dummy variable, and my dummy variable is linked to my rent forecast. And then you're going to go okay, and then this is my my DSCRs. Okay, so if I also want to show you formatting, that's why I left it like this. So you can press Control-Shift-1, and then you can press Control-1, and then if you do here custom, then you can put here an X next to it. So then this becomes an X, because normally we like to do like the covenants in, so you have like 1 point, like the base case here is 1.72 times. So it's like your income is 1.72 times greater than your debt service, than your interest that you have to pay. Okay. And then what we can do here is then highlight here and create what we call a conditional formatting, and then highlight cell color scales, and then we can do this color scales here, and then you will see more or less like what is the, of course, the best scenario is the one that you have the lower interest rates and the highest ERV. So that's our base case, but everything we want to do is like we want to stress test what happens if, things go against you. It's like the downside protection. Okay, so this is the idea of stress testing, and then seeing like, okay, what are the scenarios? And then, so my scenario one is that my interest rate went up by 2 basis points, so from 6% to 8%. My annual debt service went to 1.5 million, so it was 1.1, and then it went to 1.2. And then let me see here, the 1.1, 1.2. Yeah. So once you've done that, then creating the scenario is a lot easier. And then, so there was a 300,000 increase, so 37% increase in your debt service. And your new DSCR, your debt service covered ratio, is now 1.3. So you are breaching the 1.5 covenant that was requested in this loan. Okay, so this is a way for you to test the vulnerability of your of your interest of your investment according to change. So the question is like, what is the probability? Like, what is the risk of going from 6% to 8%? Like, how likely it is, right? So that's also the question that you need to ask yourself. So that's the whole idea of, like having foresight, because you need to know that, maybe some other investments that even if it goes to like 10%, it won't breach covenant. So that's like has less risk of breaching covenant. So that's what we need to analyze here. And then the scenario two is the ERV reduction. So 20% ERV reduction will change the headline ERV from 22 to 2.2 million to 1.7 million. And the net effective ERV is going to go from 2 million to 1.6 million due to this market fluctuation. Okay. And then you need to look at, okay, what is the impact? So the impact is over 20%, then it's going to be 20%. Oh, I missed just the 20%. Let me just change. Oops, no, minus 20%. So what happens with the minus 20% is means that if your interest rate remains the same, then you're still gonna breach your covenant, which is 1.5. So you're like 1.49 times. So it's still a breach. Okay, it's not a massive breach, but it's still you're in breach. And then there's the default risk is to check like when you're unable. So when you are below 1 times the DSCR, it means that you don't have enough to pay back to service the debt. So you are receiving less than you have to pay. So in our case here, it will be like around uh, minus 50% if the interest remains 6%, but if interest rates go up by 1%, for example, then your reduction, you need to have a reduction of 40% on your ERV in order to not be able to pay back or service this loan. Okay. So this is the sensitivity analysis that we need to carry out. So that's what we did in Excel. Now the question is, what happens when you have more than two variables? Because remember, when we did this kind of like scenarios to model, we had different variables. So what happens if you want to stress all of them, or do you need to create pairs all the time? No, we can do everything at once, but I think that is what we call like the scenario analysis. Okay. And then I want to show this in the next webinar. So if you're watching here, it's just that we won't have time, but if you're watching here, so our next webinar is going to be about the scenario how to create the scenario analysis with different variables altogether. So the trick here is for us to create the scenario. So that's going to be a very analytical process that you need to find like what is the interest, like what is the scenario is a very good base case, and you have to think about each variables in isolation and together, and in order to create the scenario. So you have to really think about it, and then you also think about, like what is the probability of the very good scenario, what is the probability of the very bad scenario. And then in that case, and then we run a data table again, we run the sensitivity table again, but now based on this different scenario. So that will be the topic of our next webinar, and I hope you join us there. And then just to close here, of course, always need to call you to interpret the results. So that's very important. Okay, so that's what we did with the scenarios and the key takeaways. So integration of the asset side and the debt side is very important. Just don't hard code I see a lot of people just hard coding the rent roll, the rent forecast, and then that, without understanding what the economics of the rent is, so that's problematic. So make sure that you are integrating with the asset model as well. And then always look at those variables that might change and might have a huge impact in your ability to pay back the debt. Okay. Check for portfolio or investment resilience, that you don't breach covenants, and technical simplicity is, of course, that you make your models beautiful and elegant, as being taught by me. Um, Best practices as well. So maybe I'll discuss the best practice in the next webinar when we go through the scenario toggles as well, the very good, and the bad scenarios and so on. The data tables, of course, that's what we need to do. And then the visual indicators. So that's the normally what we do is this traffic light colors. And then collaborative review is when we have to sit with, our analysts, our brokers, the investment principals, and then say, like, what's happening in the market. Is it really probable that this is going to happen or not? So we need to make sure that we have these discussions in order to arrive to decisions and think about the risks as well. And then, of course, I have to leave you with a call to my course, because everything I'm saying here, it's very structured in a boot camp. Our next boot camp is going to be from the 21st to the 29th of August. And then, we go through everything there is under the sun in terms of real estate financial modeling, from, buying, building, to lending, to exiting, refinance, and everything, scenario sensitivity. And then we're gonna add an AI course on top of it as well. So then you understand what's the impact of AI on financial modeling, how you leverage AI for a financial model, and research as well, like especially comparables. It's very important. So that's what I would like to call you to come and attend. And then thank you so much for attending. And also, if you're interested, because I have a book as well. So if you go to Amazon, if you say, well, I don't want to go to Maria's course because it's a whole week that I need to be there listening to her, I prefer to read her book. So then you can always buy the book here in the UK. I'm in Canada. You can buy it here as well. Okay. And yeah, that's what I wanted to tell you about today. So the stress testing, sensitivity tables, and very importantly, you need to understand how to analyze this data. And I need to tell you to come to my course, because I can tell you so much more about financial modeling, investment analysis. And I hope if you attend this webinar that you like to come and know more about it as well. Okay. So I hope that was helpful for you today. I'm just gonna stop sharing here. If you have any questions, please do let me know. Maybe do we have questions here? No, we don't have questions here. But always, please send us your questions by email, and I'll be more than happy to answer those by email or WhatsApp or another Zoom call as well. Yeah, and if you need anything, I'm here, and I hope I'll see you soon. Thank you so much.